Hello, I'm Andy Prosser. I'm the Head of Investments at InvestEngine. Welcome to our weekly market update, which is your quick look at what's been moving markets and what it means for investors. So over the weekend, we had Trump announcing more tariffs, including a 30% rate for Mexico and the European Union. But similarly to last week's tariff announcements, which we talked about in last week's video, the markets didn't seem that concerned at all because there's still plenty of time for negotiations between the August the 1st deadline. Now, what the markets did care about this week was the fate of the US Federal Reserve Chairman Jerome Powell. So on Wednesday, a White House official said that Trump was looking to replace Powell soon, which triggered an almost a 1% sell-off in the S&P. But then very soon after that, President Trump came out and said actually he had no plans to fire him. And so the market had a really quick rally, recovered all of its losses, and actually finished the day in positive territory. Also on Wednesday, we saw the UK and US inflation figures. They were released, and both were higher than expected. In the US, the impact of tariffs is now starting to make its way into higher prices for consumers, with inflation still some way above that 2% target for the Fed. It's now at 2.7%. And in the UK, inflation was even higher at 3.6%. And retailers blamed the recent price increases on the Labour government's hike in national insurance payroll taxes, as well as the rise in the minimum wage. Now, what's interesting about that, though, is the market didn't reduce its expectations for further rate cuts in the UK this year on the back of that inflation data, which you would normally expect. So it's still betting on 2 rate cuts for the rest of this year. And the lack of movement in interest rate expectations is really a sign that the market is actually a bit more concerned with the increasing signs of weakness in the labour market rather than the higher inflation at the moment. And this caution on the labour market was actually borne out in the data this week as well. So on Thursday, when we had UK employment figures being released by the ONS, the data showed that the UK wage growth was continuing to slow down and unemployment rose to 4.7%, which was up from 4.6% last month. Job vacancies, they also fell, meaning there are now 2.3 people on average seeking work for every 1 job available. And again, the main reason cited by businesses for the kind of worsening employment outlook was the combination of the hike in the minimum wage and employers' national insurance rates. And employers have now cut staff in 7 out of the 8 months since the national insurance announcement. But to finish on a positive note, in more positive news for the UK's main market, the FTSE 100, hit 9,000 points for the first time ever this week. And that's because UK stocks have been a big beneficiary this year from investors diversifying away from the US because of the kind of uncertainty around President Trump's trade war. And that means in terms of returns, the FTSE's actually outperformed almost all other major markets this year, including the US, Japan, kind of emerging markets more broadly, with only Europe posting higher returns in sterling terms. So overall, markets had a mildly positive week this week, despite all the headlines, helped by a bit of a recovery in the US dollar, which does act as a tailwind for unhedged sterling investors. So if you have any thoughts or comments, please feel free to leave them below. Otherwise, for more updates, head to our blog, sign up to our newsletter, and we'll be back next Friday. Thanks for watching.